Welcome to your weekly macro roundup, where we break down the biggest economic and market-moving developments across the United States, China, Europe, Canada, the UK, and Japan. Let's start in the United States. Inflation pressures remain sticky. Prices paid to U.S. producers rose more than expected in January, driven largely by higher services costs. That reinforces the view that underlying inflation is not fading as quickly as policymakers might like. At the same time, the trade narrative has become even more complicated. Following the Supreme Court's ruling that President Trump exceeded his authority in imposing certain tariffs under emergency powers, new claims are piling up at the U.S. Court of International Trade. Despite the legal setback, Trump is preparing to lift global tariffs to 15% where appropriate, while keeping Chinese tariffs between 35% and 50%, depending on the product. He has argued that these tariffs do not require congressional approval, even as Democrats signal they will block any extension under Section 122 when the measures expire this summer. Markets are struggling to reconcile all of this. Consumers expecting price declines after the Supreme Court decision may be disappointed, as many businesses appear ready to use any tariff relief to offset accumulated costs and pursue refunds rather than cut prices. Meanwhile, the IMF is urging the U.S. to rein in its fiscal deficit, warning that large current account and trade deficits remain a structural vulnerability. The U.S. is increasingly dependent on foreign buyers to fund its $30 trillion Treasury market. Add to that widening global credit spreads, AI-driven equity volatility, and warnings from Moody's Analytics' Mark Zandi that markets may be disconnected from economic fundamentals, and the macro backdrop looks fragile. Artificial intelligence is adding another layer of uncertainty. Kevin Warsh, Trump's pick to replace Jerome Powell as Fed chair, argues AI could unleash a productivity boom that allows for lower interest rates without stoking inflation. But not everyone agrees. Fed Governor Cook cautioned that the Fed may not be able to counter rising unemployment driven by AI adoption. Richmond Fed President Barkin stressed that rate policy shouldn't respond directly to AI disruption, while Kansas City Fed President Schmidt suggested AI could offset the shrinking labor force as the population ages. Rate futures markets are adjusting accordingly, with the next fully priced quarter-point cut now pushed back to September. Private credit is another pressure point. Treasury Secretary Scott Bessent said authorities are concerned and watching closely. UBS analysts now warn that private credit default rates could surge to 15% in a worst-case scenario, 2 percentage points higher than projected just weeks ago. Higher borrowing costs and tighter scrutiny are hitting software and AI-exposed firms particularly hard. The financial system is not in crisis, but leverage in opaque corners of the market is clearly being monitored. Demographics add a longer-term dimension. The U.S. birth rate has fallen more than 25% since 2007, largely due to fewer pregnancies among younger women. That has implications for long-run labor supply, entitlement pressures, and productivity assumptions, all feeding back into monetary and fiscal policy debates. Turning to China, Beijing has warned that any new U.S. tariffs under the pretext of trade investigations will be met with all necessary measures. At the same time, China imposed export bans on dual-use goods to 20 Japanese companies, signaling escalating geopolitical tensions in Asia. The tariff weapon remains active on both sides, underscoring the volatility of the global trade landscape. Yet there were pockets of strength. Chinese travelers set records during the Lunar New Year holiday, with domestic tourism spending reaching 803.5 billion yuan, about $117 billion, up sharply from last year. It's a rare sign of improving consumer sentiment. In currency markets, the yuan ended its longest winning streak since 2010 after authorities scrapped a fee on bearish derivatives bets, attempting to rein in appreciation. Officials continue to warn against overshooting, fearing damage to exporters and worsening deflation. Still, traders are positioning for a move towards $6.50 per dollar by year-end. Europe presents a mixed but resilient picture. Inflation surprised to the upside in France and Spain, reinforcing the European Central Bank's stance that further rate cuts aren't necessary right now. French inflation rose 1.1% year over year, above expectations, while Spain ticked up to 2.5%. Lending to Eurozone businesses slowed, however, suggesting tightening financial conditions beneath the surface. Politically, trade tensions with the U.S. resurfaced. Europe has once again frozen a trade deal with Washington amid confusion over Trump's evolving tariff framework. EU officials believe new tariffs could push duties on $4.2 billion of goods above 15%, violating prior understandings. At the same time, the EU is moving ahead with provisional application of its Mercosur trade deal in South America. Financial markets in Europe have been strong. European shares are on their longest winning streak in 13 years, supported by record buybacks totaling nearly $86 billion so far this year. Germany broke out of stagnation at year-end, with private consumption and public spending providing momentum. However, unemployment in Germany has now risen for 4 consecutive months, and credit growth to businesses is slowing. In Canada, growth disappointed. The economy shrank at a 0.6% annualized pace in the fourth quarter, largely due to a sharp drop in inventories. Full-year growth came in at 1.7%, the slowest pace since 2020, reflecting tariff pressures and weak housing dynamics. Home prices fell for the 14th consecutive month, and sales plunged nearly 6% in January. Condo markets in major cities like Vancouver remain under pressure. Yet there were bright spots. Foreign direct investment surged to nearly $97 billion last year, the highest since 2007, driven largely by U.S. mergers and acquisitions. And China agreed to drop tariffs on several Canadian agricultural exports, easing trade tensions following diplomatic engagement. Still, targeted U.S. tariffs on steel, aluminum, and autos remain in place, leaving Canada exposed. In the United Kingdom, the Bank of England sees tentative signs of a productivity revival as firms shed excess labor. Governor Andrew Bailey expects interest rates to be lowered soon, though the pace remains cautious. Britain's tariff advantage may erode if Trump implements a universal 15% rate, potentially raising export costs by $3 billion. Despite political risk, UK equities and bonds had a strong February. Finally, Japan. Prime Minister Sanae Takaichi has appointed monetary doves to the Bank of Japan board, signaling resistance to further rate hikes. Reports suggest tension between the government and Governor Kazuo Ueda over the path of tightening. The yen weakened following news that additional hikes may face political resistance. Meanwhile, Japan faces structural challenges as India closes in on overtaking it as the world's fourth largest economy in dollar terms. In sum, inflation persistence, trade policy uncertainty, AI disruption, and private credit risks topped the market this week. That's your macro roundup for this week. If you enjoyed watching this, kindly like, share, and subscribe, and don't forget to turn on the notification bell. Cheers, and see you next week.